Are you not sure how to distribute input tax credit to your branches or units on services purchased? Did you know that you can optimize your GST outflows in cash by allocating a suitable amount of ITC across branches of your organization? Become an input service distributor to benefit from an optimized cash outflow under GST. You are in the right place to get complete details of the same, and watch this video till the end to also know the differences between ISD and cross-charge, often confused by people under GST. Hello friends, I'm Annapurna from Team Clear, India's largest tax and financial services platform. At Clear, we serve more than 2,000 large enterprises, 80,000 plus tax experts and 4 lakh plus growing businesses. Welcome back to our channel, and if you happen to be new here, I have some exciting announcement for new subscribers. We have a free gift for you. It's a GST compliance calendar that will help you stay 100% GST compliant without any stress. To claim it, subscribe to our channel and let us know in the form provided in the description below. Without further ado, let's begin with this video. Let's check out first, what exactly is an ISD? Input Service Distributor is not a new concept under GST. It was prevalent even under the service tax regime. Let me explain the ISD concept with the help of an example. An ISD is an office of a supplier, mostly a corporate office or a head office or a main office. It can be just one office of a supplier who also has many other offices, branches or units. In other words, the supplier has multiple GSTINs or registrations in one state or many states across India under a single permanent account number or PAN. The main office or selected office of a supplier may have purchased services that are commonly used across the organization, that is either multiple GSTINs or all GSTINs under a single PAN. A few examples of such services can be audit fees, tax consultant fees, outsourced IT services or maintenance fees used and paid for organization as a whole of a more than one branch. Such a main office or selected office has received tax invoice against the input services. Note that the ISD benefit is available only for input services and not against inputs or capital goods. We know that input tax credit or ITC would be in the form of IGST, SGST and CGST. The supplier will be able to distribute all these taxes to a particular GSTIN under the same PAN as the office of supplier or the input service distributor in this case. Now that you know who is an input service distributor, let's check out the provisions of input service distributor as given by the GST law. Section 2, subsection 61 defines ISD. Section 20 covers manner of distribution of credit by input service distributor, read with rules 36, 39 and 54. Section 21 covers manner of recovery of credit distributed in excess. Section 24 covers GST registration, which is said to be mandatory for ISD, read with Rule 8. Section 39 subsection 4 covers requirement for filing GST returns in form GSTR 6, read with Rule 65. ISD can distribute ITC by following certain GST rules. Let's refer to them as ITC distribution rules. Let's check them out one by one. The first question you may ask is, how exactly will ISD distribute IGST, CGST and SGST credits to other GSTIN recipients? Will they be distributed as it is or will they change form? Here, one must recall that any interstate sales attract IGST, whereas any intrastate sales or sales within the state attract both CGST and SGST. So the answer to this question depends upon whether the ISD and the recipient unit are located within the same state or different states. Take a look at this 2x3 matrix on your screens. On one hand, you see two options for the location of ISD and the recipient unit as same state and different state. On the other hand, you see three different options for the ITC available with ISD for distribution as IGST, SGST and CGST. Let's take up the first scenario where the location of both ISD and recipient is in the same state. Consider that ISD has received a credit of CGST. the ISD can transfer the CGST credit as CGST only. In the second scenario, where the location of both ISD and recipient is in the same state, the SGST credit can be distributed as SGST only. In the third situation, where ISD is located in the same state as recipient and has received IGST credit, he can distribute it as IGST. Coming to the bottom row, which is the fourth situation, the ISD is located in the different state when compared to the recipient and has received CGST credit. He can distribute it as IGST after totaling it up with the equivalent SGST amount. Moving to the next box, which is the fifth scenario, the ISD is located in different state when compared to recipient and has received SGST credit. Then he can distribute it as IGST after totaling it up with equivalent CGST amount. Moving to the last situation, the ISD is located in different state when compared to recipient and has received IGST credit. Then he can distribute it as IGST only. Finally, this is how the distribution looks like. If Unit 1 is in the same state as ISD, then CGST, SGST and IGST, ITC are distributed or transferred as it is. If Unit 2 is situated in another state different from ISD, then CGST, SGST, IGST will be distributed as IGST, that is after totaling up CGST and SGST components as IGST. Let me pause here to see if you have any doubts about the illustrations we presented. Type in clear in the comment section below if this was clear to you. Else, feel free to type in your queries. We'll be happy to answer them for you. Moving on, the next question you probably want to ask is how much ITC can ISD distribute to each of its recipient units, branches or GSTINs under the same PAN. Suppose I am an ISD having Rs 10,000 worth of ITC to be distributed. I have 3 recipient units. Can I equally distribute or should I follow a rule? You might have guessed it already. CGST rules prescribe that the ITC is distributed to recipients in the proportion of turnover earned by the units. That is, turnover that is earned by each GSTIN or the recipient unit to the total turnover of all eligible units of supplier which have used that input service. There are some important points to note here. Input tax credit on a specific input service used entirely by one recipient can be allocated only to that recipient for utilization and not to any other recipients. The tax credit available against the input services used commonly by more than one recipient of the ISD shall be allocated to those recipients on a proportionate basis in the ratio of turnover of all such recipients that are operational during that year. The formula for the same is C1 equals to C multiplied by T1 divided by T, where C1 is equal to ITC to be distributed to recipient, C refers to total ITC available for distribution, T1 refers to turnover of the specific recipient, T refers to total turnover of all recipients to which ITC relates. The tax credit available against the input services used commonly by all recipients of ISD shall be allocated to all recipients on a proportionate basis in the ratio of turnover of all recipients that are operational during the year. The formula remains the same as C1 equals to C multiplied by T1 divided by T. The turnover is referred to the previous financial year. However, if that is not available, then turnover of last quarter is taken. If there are multiple units in one state or union territory, then the sum of their turnover in that state is taken for T1 in the formula. Credit attributable to a recipient is distributed even if such recipient is unregistered or making exempt supplies. Both eligible and ineligible ITC has to be distributed in the same manner by the ISD. It is mandatory to register separately as ISD even though it has obtained registration as a normal taxpayer in REG 01 by check marking under serial number 14 of the form that it is registering as ISD. Different offices of company can have separate registrations as ISD. In other words, a company can have multiple registration for its offices as ISD. ISD is supposed to issue an invoice known as ISD invoice to all those units to whom it intends to distribute the credit of the tax paid on services. It should clearly indicate in such invoice that it is issued only for distribution of ITC. The ISD invoice must have fresh series of invoice numbers except for banks. Then GSTINs of both ISD and recipient apart from the details of ITC. He needs to issue an ISD credit note if the ITC that is already distributed gets reduced for any reason such as wrongful distribution or allocation. Also, if the amount to be reduced exceeds the amount of tax credit to be distributed, then such excess shall be added to the output tax liability of recipient. The same process shall be followed for all those cases where credit distributed needs to be reduced for any reason. Similarly, if any additional ITC needs to be distributed for an invoice, then the ISD debit note should be issued in the same month as it is reported in GSTR 6. ISD have to file GSTR 6 by the 13th of the month succeeding the relevant month, indicating the credit distributed for relevant month to the recipient units and the ISD invoices issued in the relevant month. It will be wrongful distribution of ITC by ISD if credit is distributed to all or any recipient in excess of the amount available for distribution, distributed in an inappropriate ratio to all or any recipient, distributed in excess to what a supplier is entitled to and shall be recovered from such recipient along with interest, and the provisions of demand and recovery shall apply for effecting such recovery. Accordingly, the provisions of demand and recovery will get attracted as if tax was not paid. Recovery of excess credit distributed along with interest shall be initiated against the recipient and not ISD. Coming to the much awaited section of this video, let's compare ISD with cross-charge. ISD is a concept used for distribution of ITC to one or more supplying units, whereas cross-charge refers to accumulation of ITC that is scattered at different locations to a central location. ISD is restricted for distribution of ITC on input services, whereas cross-charge covers inputs as well. The scope of ISD is narrow with several restrictions about invoicing, additional return filing, and that the month of claim and distribution has to be same, whereas the scope of cross-charge is much wider. ISD is restricted to ITC distribution on external procurements, that is different PANs, whereas cross-charge allows distribution of ITC on internal procurements or stock transfers as well. We have come to the end of this video. To read more about ISD GSTR 6 filing and related rules with examples, please check out our articles. I have left the links to it in the description box below. Please like and comment if the video was helpful to you. Also share it with your team, friends and fellow professionals who can benefit from this. Don't forget to subscribe and fill the form to win your gift. Thank you.